Welcome back to Talk Tickers. It is Monday, February 2nd, 2026.
And we are right in the thick of earnings season.
We are deep in the trenches, and we're filtering out the noise to find the signal. Today, we are looking at a company that pulled off, one of the most interesting intraday reversals we've seen in a while.
Oh, for sure.
ArcBest Corporation, ticker symbol ARCB.
And interesting is, putting it mildly, if you were watching the tape this morning, you saw a classic head fake.
Absolutely. So let's set the scene for everyone. The print drops, and the stock immediately sheds, nearly 4% pre-market.
Yep. Looked like a bloodbath was coming.
But then the opening bell rings, the liquidity comes in, and the entire narrative just flips.
Completely flips.
By the close, ArcBest is up 5.76%, sitting at $9.22.
And the conviction behind that move was real. We aren't talking about a retail drift higher. We saw over 900,000 shares trade hands.
Wow.
And for context, their average daily volume is around 375,000.
So that's institutional accumulation.
That is big money stepping in and saying, we are buying this dip.
Okay, so that is our mission for this deep dive. We need to figure out why the smart money looked at a report that included an earnings miss and a net loss, and just decided to buy with both hands.
Because on the surface, you're right, the headline numbers were messy.
Very noisy.
Let's strip it down. Revenue for Q4 2025 came in at $972.7 million.
Which was actually a beat.
It was a beat. Consensus was around $963 million. So the top line is holding up better than people thought.
But the bottom line, the EPS, that's where the initial panic came from.
Right. So the street was looking for about 45 cents non-GAAP. ArcBest delivered 36 cents.
That's a roughly 20% miss. And if you look at the GAAP number, it's ugly.
It's very ugly.
A net loss of 36 cents per share. Usually a print like that gets you taken out to the woodshed.
Usually, yes, but you have to look at the quality of that loss, if that makes sense.
Explain that.
That GAAP figure was heavily dragged down by a $9.1 million after-tax non-cash impairment charge. It's an accounting write-down.
So it's not cash bleeding out of the operations.
Exactly. The market algos might react to the headline initially, but, human analysts, they strip that out immediately.
Okay, so we ignore the impairment charge. But even at 36 cents adjusted, they still missed.
Yeah.
Why did the stock rally almost 6%?
Because I think investors stopped looking at 2025 and started looking at the structural changes. This is a kind of a two-speed story.
Okay.
You have the core asset-based LTL business, which is, let's say it's bending but not breaking in a brutal environment.
Right.
And then you have the asset-light business, which has been a complete disaster area for the last year, and it's suddenly showing signs of life.
Let's start with the core then, the asset-based side. This is the trucks, the terminals. The operating ratio, the OR, came in at 96.2%. Now, we know the LTL game. A 96 OR is thin.
Very thin.
That's a 420 basis point deterioration year over year. In most cycles, if a carrier blows out their OR by 400 basis points, the stock gets crushed.
No. It's a significant deterioration, no doubt about it. But you have to look at the drivers. This wasn't really an efficiency collapse. It was more of a density issue.
This brings us to the whole volume versus yield debate.
Exactly.
Shipments per day were up 2.4%, and tonnage was up 2.6%.
Which, by the way, in a freight recession entering its fourth year, volume growth is an outlier.
That's a great point. They're winning market share.
They are. But look at the yield. Billed revenue per hundredweight dropped 2.7%.
See, and that's where my alarm bells ring. Usually when I see volume go up and yield go down, it means one thing.
Price wars.
They're slashing prices to buy volume. It's that race to the bottom scenario.
Right. But management, and specifically CEO Seth Runser, was very, very defensive about this.
They claimed it wasn't a pricing issue, but a mix issue.
And you and I have heard mix shift every time a carrier misses on yield.
So do we believe them this time?
I think so. In this case, the data actually seems to support them. You have to look at the profile of the freight. ArcBest has historically moved a lot of heavy, industrial, almost truckload-sized shipments through their LTL network.
Yeah.
In Q4, that heavy freight it evaporated. It's gone from the market.
So they had to replace it.
They replaced those heavy pallets with lighter, more traditional LTL shipments.
Okay, so it's a physics problem. If I replace one 2,000-pound pallet of steel with, say, 3 500-pound pallets of consumer goods, my revenue per hundredweight crashes because the denominator, the weight is totally different.
Precisely. But the revenue per shipment might still be healthy. It's a density problem, not a pricing problem.
And they gave proof on pricing.
They did. Runser noted that their deferred price increases averaged 5% in Q4, which is up from 4.5% in Q3.
You do not raise contract rates by 5% if you're in a price war.
You don't. The market looked at that stat and said, okay, the pricing discipline is still intact.
So the core business is surviving the density drought. But the real surprise, and I suspect the primary driver of this rally, was that asset-light segment.
Oh, absolutely.
This has been the anchor dragging the whole ship down for quarters.
It has been a cash incinerator. In Q4 of last year, asset-light lost $5.9 million, just bleeding money.
And this quarter.
They swung to break even on a non-GAAP basis.
That is a massive swing in profitability. What on earth changed?
Well, they definitely cut costs, but it was strategic. They stopped chasing what you might call empty calories. They walked away from low-margin transactional truckload freight. They basically said, if we can't make a good margin on it, we are not hauling it.
And they pivoted hard to something called managed solutions.
Right, which I know sounds like standard corporate jargon.
It does. Is there actually meat on that bone?
There is. It's the difference between being a commodity broker and a strategic partner.
Okay.
In managed solutions, ArcBest acts as the outsourced logistics department for the client. They handle the complex stuff. That business saw double-digit growth in shipments per day.
And it's stickier, better margins.
Exactly. And it fits the whole narrative of Mac Pizzoton, the new COO of Asset Light. This feels like his first real scorecard.
It validates his strategy. You're right. The market loves a turnaround within a turnaround. If Asset Light just stops bleeding cash, ArcBest suddenly becomes a much more profitable company.
Even if the macroeconomy doesn't get any better.
Speaking of improvement, we have to talk about the efficiency measures. I feel like every earnings call in 2026 has an obligatory AI section.
It's the new buzzword.
And usually I roll my eyes because it's just a CEO trying to pump the multiple. But ArcBest, they put some hard numbers on the board this time.
They did. They cited $24 million in annual cost savings from their continuous improvement programs.
And a big chunk of that is coming from city route optimization.
Right, the algorithmic routing for pickups and deliveries.
And that's not just talk.
No. Phases 2 and 3 of that project saved $2 million just in 2025. That might sound small for a billion-dollar company, but that goes straight to the bottom line.
And then there's Ava, the virtual agent.
The number that jumped out to me was 120,000 automated email quotes.
That's a staggering number. Think about the man-hours involved in reading, processing, and replying to 120,000, quote, requests.
It's massive.
But let me play devil's advocate here for a second. Is this actually a competitive advantage? I mean, Saia, Old Dominion, XPO, they all have tech stacks. Is ArcBest actually ahead? Or is this just table stakes to survive in 2026?
That is a very fair pushback. And in the long run, it probably does become table stakes.
But right now,
for ArcBest specifically, it's all about operating leverage. They are lowering their break-even point. They're proving they can maintain revenue with fewer heads.
So the bull case isn't that their AI is sentient.
Not at all. The bull case is that when volume eventually returns to the market, they won't have to hire back all the staff they let go.
The classic coiled spring theory. Revenue comes back, costs stay flat, margins just explode.
Exactly. And that brings us to the macro discussion, because management was surprisingly blunt about the environment.
They were. They explicitly called out a prolonged freight recession entering its 4th year.
4 years. That is a lifetime in logistics. We're talking about a downturn that has lasted longer than the dot-com bust and the 2008 financial crisis for this sector.
It's historic.
Yeah.
And that's what makes the Q1 outlook so fascinating.
Right. They guided for the asset-based ORR to worsen by another 100 to 200 basis points sequentially.
And if you just read that in a vacuum, you sell the stock.
Of course.
But the stock went up. So the market is grading on a curve.
It's not just a curve, it's seasonality. Historically, Q1 is always their worst quarter. You have the post-holiday hangover, the weather.
All of it.
On average, their ORR worsens by 260 basis points in Q1. So by guiding to a 100 to 200 basis point drop, they are actually signaling a relative improvement.
They're outperforming seasonality.
Yes, and that's despite a brutal start to 2026 weather-wise.
January was nasty. They mentioned severe winter storms, service center closures.
And yet January tonnage was up 8%.
Wait, say that again? Tonnage is up 8% in January with half the network frozen?
Yes. Now the comp is easy because last January is also bad, but it shows resilience. And that resilience gave them the confidence to reaffirm their 2028 targets.
Let's look at those. $12 to $15 in EPS by 2028. We just saw a quarter with a GAAP loss.
Right.
That implies a massive, massive ramp.
It does. But the kicker was the CFO, Matt Beasley, stating they can hit those targets without a significant market recovery in 2026.
And that is the self-help thesis in a nutshell.
It is.
We don't need GDP to go to 4%. We just need to execute on our own plan.
And you see that discipline in the CapEx guidance. Net CapEx for 2026 is guided down to $150 to $170 million.
Which is below 5% of revenue.
Yeah.
Is there a risk there, though? Are they starving the network? If they underinvest now, do they break when the volume comes roaring back?
That's always the risk with aggressive CapEx cuts. But you have to remember, we're in year 4 of a recession. They have excess capacity. They have empty doors at terminals.
Right. They don't need to build more real estate.
They need to fill what they have. Cutting CapEx preserves liquidity. They have about $400 million on hand. And it signals to shareholders they are focused on returns, not just empire building.
So let's tie this all together for you, the investor. ArcBest is up almost 20% in the last month. The transport ETF, IYT, is up barely 3%.
It's a huge outperformance.
This is clearly an idiosyncratic move. The market has decided that ArcBest has decoupled from the general transport sucks narrative.
Correct. The market is pricing in a bullish reversal based on execution. They fixed the asset-light bleed, they're managing the density decline in LTL, and they're using tech to clamp down on fixed costs.
It's a classic value play.
It is. You buy the bad news because the underlying structural setup is actually improving.
It really feels like the market believes the bottom is in. Not necessarily the economic bottom, but the operational bottom for ArcBest.
That's the key distinction. If they can break even in asset light and hold a 96 OR in LTL during the worst of the winter in year 4 of a recession,
Then the downside is floored.
the downside is pretty much floored. The only way is up from there.
All right, that brings us to the fun part. The segment where we take the gloves off. And the standard disclaimer. This is absolutely not financial advice. We are podcast hosts, not your financial advisors. Please do your own diligence.
Please.
But looking at this setup, if you were pitching a high-risk, high-reward trade to a hedge fund committee, what's the play?
I'm calling this one the recession-proof robot trade.
Okay, I'm intrigued. Break it down.
The market is currently valuing ArcBest at roughly $90 a share. That's, partially recognizing the turnaround, but it's still pricing in a lot of skepticism about the macro environment.
For sure.
My thesis is that the market is underestimating the leverage from the AI and all these cost-cutting initiatives.
You think the coiled spring is even tighter than people realize?
Much tighter. Management says $12 of EPS in 2028 without a recovery. But what if we actually get a freight recovery in late 2026 or 2026?
Even a mild one.
Even a mild one. With their fixed cost base so much lower because of the tech integration and the asset light fix, that $12 of EPS could easily be $18 or even $20.
So you're basically applying a multiplier to their guidance based on a cyclical upturn.
I am. So the trade is this. Long ARCB, targeting a move to, say, $120, $130 by the end of the year. But to hedge that macro risk...
Because the economy could tank further.
Let's be honest, it could. So you pair it, you go short a plain vanilla brokerage or maybe a heavy asset carrier that hasn't invested in tech and is still bleeding cash.
So it's a pair trade. Long the innovator and the turnaround story, short the dinosaur. You strip out the market beta and bet purely on ArcBest's execution.
Precisely. If the whole sector rallies, ArcBest should outperform because of the leverage. If the sector tanks, ArcBest should hold up better because they've already cut the fat, while the dinosaur just drops faster.
I like the asymmetry there. You're betting that the self-help story creates alpha, regardless of what the GDP does.
And if that $12 EPS target starts looking conservative, if they start hinting at $15 or $16, the multiple expansion on this stock could be violent.
A double.
We could be looking at a double over the next 18 months.
A compelling thesis. The recession-proof robot.
Yeah.
Again, purely hypothetical, don't bet the farm.
Only bet what you can absolutely afford to lose.
So, to wrap up this deep dive, ArcBest delivers a beat on revenue, a miss on earnings that turns out to be mostly noise, and a massive, massive pivot in their problem child segment,
And the stock rips 5%.
signaling that investors are finally looking past this brutal freight recession and focusing on that 2028 horizon.
It's a story of resilience. Management is playing the long game. They've decided not to wait for the economy to save them, and it seems the market is finally rewarding that agency.
And sometimes, the most profitable trades are the ones that look the ugliest on the headline. Fascinating stuff. We will be watching that QNOR very closely to see if they can beat the weather.
It's going to be a bumpy quarter, no doubt, but the trajectory is set.
As always, check the charts, do your own research, and keep listening. We'll see you on the next deep dive.
Thanks, everyone.